I had the down payment saved by 26. Your dad says it like it's just weather, just how things were. He bought the house with the maple tree out front the year he turned 29. You just turned 38. You make more than he ever did. And last week you signed another 12-month lease on a place that isn't yours. So here's the question sitting in your chest. When did you fall this far behind? You didn't. The starting line moved. Jake found that out the expensive way. 38, solid job. 8 years of rent paid on the first without fail. And a Zillow app he opens like other people check the weather. Here's the truth this whole video is built on, and it deserves the plainest words there are. You are not a failure for renting at 38. The age at which people buy their first home has slid all the way to 40, the oldest on record, in barely a single generation, and almost nobody bothered to update the story you were handed about when you're supposed to own a place. The finish line you've been sprinting towards isn't standing politely still, waiting for you to catch up. It's been jogging away from you at roughly a year per year, and lately it found another gear. At Mr. Sense, we spend way too much time figuring out why doing everything right still doesn't move you forward. So if you've ever wondered who moved the goalpost while you weren't looking, subscribe. We break down one money trap a day, so you see the next one coming. Start with the number that put all of this on the map. The National Association of Realtors, the people who actually survey who's buying houses in America, say the typical first-time buyer is now 40 years old. 40. To feel how strange that is, rewind the tape. In 1991, that same typical first-timer was 28. Your parents' generation got the keys before they got their first gray hair. The generation right behind them is staring down its 40th birthday from inside a rental. And it isn't just that buyers got older, it's that first-timers are vanishing. First-time buyers are now 21% of the entire market, the smallest share since anyone started keeping track back in 1981. Here's what that actually looks like. Walk into a room of 5 people buying homes this year, and 4 of them already owned a home before. The first timer, the person doing it brand new, the person you are trying to be, is the rarest one in the room. So who's buying instead? The answer is almost funny, except it isn't. The typical repeat buyer is now 62 years old. By one count out of Deutsche Bank, 46% of every home bought in 2024 went to someone 60 or older. The housing market, the thing sold to you your entire life as the foundation a young family builds on, now mostly belongs to people closer to a retirement party than to their first real paycheck. Let that land. Picture Grandpa Joe and Grandma Betty. They bought their place back in the 80s for about 3.5 times what Joe made in a year. Roughly what a nice new car costs today. They watched it quietly become the most valuable thing they will ever own, and they are not selling it. Why would they? They're locked in. Their mortgage is paid off, or sitting at a rate from another era, and moving would mean trading it for today's prices and today's rates. Multiply Joe and Betty by 20 million plus households, sitting on a pandemic-era mortgage under 3%, like a dragon on a pile of gold. And short of a divorce or a hearse, they are not listing. So the starter homes that used to pass from one generation to the next just don't. You're not being outbid for the house. The house is being guarded. There's a name for what's happening to you here, and once you see it, you cannot unsee it. We call it the moving goalpost, the milestone that slides away from you at exactly the speed you run toward it. And it's worth understanding why it moved, because it wasn't your spending. In 1985, a typical home cost about 3.5 times a typical year's income. Today, that same ratio is 5. Homes didn't just get more expensive, they sprinted away from paychecks and they never came back. It's the same house your parents bought, with double the price tag and half the income left to reach it. Now here's the part that quietly decides who clears the bar young and who's still renting at 40. And a very specific comment is already being typed about all this. So hold that thought, we promise we'll get to it. The people still buying a first home early mostly did not out-hustle you. They got a running start. Among recent first-time buyers, 22% used a gift or a loan from family to pull it off, and a record 7% used an inheritance. And this isn't a feeling, it's measured. The San Francisco Fed studied exactly this and found that kids whose parents pulled cash out of their own homes were more than 3 times as likely to become homeowners themselves, and ended up with 39% more housing wealth by the age of 30. The Head Start isn't a metaphor, it has a number, and the number is enormous. Which brings us to 2 rules you inherited without anyone ever saying them out loud. Buy a house by 30, and save 20% before you do. Both of them made sense once. Both quietly expired and nobody mailed you the notice. Meet Alex. He's 26. He's got the degree, he's got the job, and he's carrying the median student loan his entire generation is hauling around. About $30,000 of it. There's a Federal Reserve study that found every extra $1,000 in student debt pushes your first home back about 4 months. Run that math on $30,000 And Alex started the race years behind the line. He's got a spreadsheet open right now trying to calculate when he'll ever own a place. And the goalpost is still drifting forward, ahead of even him. He's doing money math his parents never had to do, and the answer keeps getting longer every time he runs it. Let's walk Jake's actual month, line by line, because this is where the goalpost stops being a metaphor and starts being your bank balance. Jake takes home $4,180 a month. Rent is the first and biggest bite, $1,680, and it leaves him $2,500. The car payment, the insurance, and the gas to reach the job that pays for all of it, $590. The student loan and the credit card minimum, $290. Food, utilities, the phone, and the rest of the unglamorous business of staying alive, $920. Add it all up, and Jake has about $700 left to put toward a down payment. $700 a month, on paper. But paper isn't a life. In March, the brakes go. In July, the air conditioner dies on the hottest day of the year. There's a dentist, a kid who needs cleats, a wedding 3 states away he can't say no to. Nationally, the savings rate says Americans actually bank about 5% of what they earn once real life takes its cut, which for Jake is a lot closer to $360 a month than $700. And here's the number Realtor.com ran for the whole country. At that pace, the typical down payment, about $30,400, now takes around 7 years to save. 7 years of doing it right. And here's the cruel twist that turns a ladder into something else entirely. In 7 years, at the speed this market climbs, that down payment won't be $30,000 anymore. Jake isn't climbing a ladder, he's climbing an escalator that's running down. Look at it one more time. He is saving faithfully every single month toward a finish line that is moving away from him faster than he can walk toward it. And here's the gut punch hiding inside the gut punch. Jake is 38. In 2 years, he turns 40. Which by the headline number would make him a perfectly ordinary first-time buyer. Right on schedule. That is how far the schedule has moved. His reward for doing everything they told him to do? Congratulations, Jake. You out-earned your father and out-saved your mother, and the grand prize is another 12-month lease. Before the comments catch fire, let's Steelman the other side, because there's a real argument here, and ignoring it would be cheating. The objection goes like this. That 40 is junk. It comes from a tiny mail survey. The actual mortgage records say first-time buyers are still about 33 and basically right where they've always been. This whole thing is doom-mongering. And here's the honest part. That's a fair hit. The 40 really does come from a mailed-out survey. Around 6,000 responses total, and only about 1,300 of those were first-time buyers. And the kind of person relaxed enough to fill out a 120-question form about their home purchase tends to be older and more settled, almost by definition. Meanwhile, the Mortgage Bankers Association and the New York Fed, working off millions of actual mortgage records instead of a survey, both peg the typical first-time buyer at 32 or 33. So let's concede it cleanly. The precise 40 is probably a few years too high, and the typical American buying a first home with a mortgage is closer to 33. But, and this is the entire point, both numbers tell the exact same story. Even 33 is years older than the 28 of 1991. And the facts nobody on either side disputes are the brutal ones. First-time buyers really did crater to 21% of the market. The median buyer overall really is closing in on 60. And home ownership among people under 35 is genuinely falling. 33 or 40? The goalpost moved. So stop measuring your age against a number people are still arguing about on the internet. Measure the 2 numbers that are actually in your hands instead. Your down payment target and your zip code. Your birth year was never a lever. Those 2 are. Because here's the thing about a goalpost that moved. A moved goalpost is not a locked door. This is the page the handbook skips. There are 3 levers still sitting in your hands right now, and most people go their whole lives without touching a single one. So let's count them. Lever 1. Kill the 20% myth. You do not need 20% down to buy a house, and the widespread belief that you do is single-handedly keeping people renting for an extra decade. The typical first-time buyer today puts down 10%, not 20, and the actual floor is far lower. A conventional first-timer program will go to 3% down. An FHA loan, that's the government-backed one, to 3.5%, and a VA or USDA loan, for those who qualify, all the way to 0. Watch what that does to the math. On a $400,000 home, 20% is $80,000 you almost certainly don't have sitting around. 3% is $12,000. One of those is a fantasy. The other is a serious but reachable savings goal. Remember Jake's 7 years? A huge chunk of that timeline is the 20% assumption baked into it. Zillow once ran this exact comparison, saving a full 20% down payment At the rate renters typically save took almost 27 years to study, but saving just 3% took about 4. Almost 27 years versus 4. That's the gap the myth is hiding. Now, the honest catch, because we never skip the catch. If you put less than 20% down, you'll pay PMI, private mortgage insurance, which is just a monthly fee you cover to protect the lender, not you. And it stays on your bill until you've built up enough ownership in the home to drop it. A smaller down payment also means a bigger loan and more interest over time. None of that is free. But here's the rule that cuts through it. The 3% door gets you inside the house years sooner. And every one of those years you're building equity instead of handing a landlord rent you'll never see again. If the monthly payment works, that trade is almost always worth taking. Lever 2. Move the math, not just yourself. The very same income that is completely hopeless in the Bay Area, where the typical San Jose home runs about $1.9 million, and saving a down payment in San Francisco can take you something like 36 years, makes you an actual homeowner in Detroit, where the average home sits around $203,000. In San Antonio, the down payment math is closer to a year and change, not 3.5 decades. You can even see it in the ages. The typical first-time buyer is around 28 in places like Des Moines, and 35 or 36 in Los Angeles and New York. Same person, same salary, same savings, same discipline, and a different zip code hands them back a decade of their one life. The goalpost was never a single national line. It's drawn in a different spot in every city, and you get to choose the city. Lever 3. Use the help that already exists. The help almost nobody bothers to look up. There is an entire machine built specifically to pull first-time buyers through the door, and most people never even open the brochure. FHA loans at 3.5% down. Conventional programs with names like Home Ready and Home Possible at 3% down for buyers under the area median income, which just means the typical income for where you live. 0 down loans through the VA and USDA for those who qualify. And in nearly every state, a housing finance agency quietly handing out down payment grants, forgivable second loans, and tax credits. The exact amounts and rules change all the time. So the single highest value move you can make is to look up your own state's program before you ever assume you don't qualify. That is exactly what Alex finally did. He closed the spreadsheet that kept telling him 40. He opened his state's housing agency page for the first time in his life and found a down payment assistance program he'd never heard existed. The goalpost didn't politely move back to meet him. He just stopped staring at it and found the door that was already standing open. And it's worth saying out loud why any of this is worth the fight. Because renting forever gets sold as the easy, flexible, modern choice. The Urban Institute put a number on it. In 2022, the typical homeowner had about $390,000 more wealth than the typical renter, a gap that's grown by roughly 70% over the past 3 decades. That isn't a lecture about your coffee. It's the single clearest reason the people guarding those houses are guarding them so tightly. So that thing your dad said, I had it saved by 26, it was true. For his math, the house with the maple tree cost him about 3.5 years of his income. The exact same house today costs 5. He didn't try harder than you. He didn't love his family more than you love yours. He just started on a shorter track, in a decade when the track was shorter for everyone. The typical first-time buyer is 40 now by one count, and 33 by another. And either way, an entire generation got pushed back years through no fault of its own. But the goalpost only wins if you keep aiming at the number it keeps moving. If you want the companion piece to this one, the genuinely brutal math on whether you can even afford to have a kid in this economy, the baby break-even episode is exactly where this story goes next. We do this every day. One money truth, nobody else is laying out this plainly. Subscribe so you catch the next one. Your parents got the keys at 28. You'll get yours on a timeline nobody handed you. The one you ran the real math on yourself, with your eyes open.